So hello everyone and welcome to this iAIM weekly fall series. My name is Clément Gignac, Chief Economist at iAIM Financial Group. Just like this summer with our summer virtual tour record from my gazebo, we initiate now this new series live from my home, and I will be the moderator. And each week at this time, 11 o'clock on Wednesday, I will have the privilege opportunity to have a guest speaker, one of my colleague, portfolio manager. And so before presenting, in fact, I just want to tell you that you have opportunity to ask questions to our guest speaker. So do not hesitate to use the chat box. So my first guest, I'm very pleased, is in fact Marc Gagnon is a senior VP and a portfolio manager for North American Equities. Marc have more than 25 years experience in financial industry, more than 20 years with IA. He managed the Canadian Equities as well, the growth fund that we will talk about again. In this kind of, it's already more than 6 months now that the market is influenced by this pandemic. So even if we are not out of the wood yet on the economy, with a lot of people still unemployed, in fact, the market has recovered all the losses. And the question, do we have more fuel left, any fuel left in the tank? That's probably the question you have. So to answer to that, and I don't want to put too much pressure on your on your shoulder, Marc, but welcome, and we are just curious to hear you. So maybe share some thought with us during 20-25 minutes, and after that we go to questions. So the floor is yours, Marc, and welcome again.
Thank you, Clément. Thank you to invite me to this webinar. It's greatly appreciated. Well, I guess that when we want to ask, do you answer the question, what's left for 2020, what's in store for the first months of 2021, I think the first thing we can take a look at is what's been the year so far. What are the returns year to date of the main asset classes available for Canadian investors? And without too much surprise, you're going to see that bonds have had good years. You have the Canadian Universe bond at 8% of return after the first 3 quarters of the years. And corporate bonds did good also, not as much as sovereign bonds, for example, but still at 6.8%, that's quite a decent return. But I guess that the biggest surprise comes from a stock market is one of the market that gave the most return so far this year after 9 months. And you have to realize we're in quite an exceptional situation with the pandemic. But nevertheless, the S&P 500 in Canadian dollar, the return translated in Canadian dollar gave a return so far of 8.7% and 0.75. So it's quite a good surprise. Canadian stock market a little behind zero, a little negative at 3.1%. And you have the rest of the world, the MSCI EFI, and still converted in Canadian dollar, a little down a little more at 4.3 negative. So overall, depending, of course, of your asset allocation, the return of your portfolio should be near zero or even slightly positive so far in 2020, which is as I said, it's quite surprising with the exceptional situation we're going through. And I think that the biggest reason why returns are not that bad, it's probably because the fiscal support given by all the major government around the world has been there, has been strong without any weakness. We've seen a lot of programs, some iterations of old programs being renewed. And I think that it's really the key of a situation that could have been much worse than what we have seen so far for financial markets. But now it's time to take a look at what's coming, and there's a couple of clouds, on the horizon, and some are closer than other, but most of them are kind of not too far. Especially the first one, the COVID-19 cases accelerating, and we can probably say that we are in that second wave right now, without too much doubt. There's also the U.S. election coming in a couple of weeks, less than 3 weeks now, and there's uncertainties coming from that election, and we're going to take a look at what could play out there in a couple of minutes. We're still waiting also for that new fiscal stimulus in the U.S. There's been negotiation on that package since the end of July, actually, and it's dragging on. And you know what? It's quite possible that it's not going to be settled before the election. But probabilities to have a new package somewhere after the election are much better, if you were, to my personal view. And some of the bear out there will be quick also to point that right now valuations for different, stock market, North American stock market, both Canadian and U.S., is fairly high, and it might be a little, awkward to see valuation being so high right now when we're going through a pandemic situation. But we also gonna take a look at that, and then some reasons support, higher valuation than usual. But first, let's talk a bit about, what could put to rest the COVID-19 situation. And I think that, we're all going to agree that vaccine is the best weapon to get out of this situation. And although we're seeing 2 of those 5 high-profile studies being put to a halt in the U.S., the AstraZeneca one a couple of weeks ago, and the Johnson & Johnson just 2 days ago, we have to keep in mind that there's actually, with human tests going on, there's 44 different studies at different level of achievement. And the 5 ones that we're presenting there, both AstraZeneca and Pfizer and Johnson and Moderna and Novavax, are still going on outside of the U.S. or in the U.S. Outside of the U.S. for AstraZeneca, there's still 15,000 people being enrolled, and the study still goes on there in Brazil with 15,000 people being, in the study, 12,000 in the UK. So it's a huge, it's 50,000 for AstraZeneca, 44,000 for Pfizer people being enrolled. So these are a very important study, and I think the main messages that we have to remember here, it's normal first to have pauses. It was quite ambitious to think that those studies will go through without any glitches. And furthermore, all these studies should provide results somewhere in November or December. The FDA approval might take a couple of days more to come, but nevertheless, I think that once we get positive news from one or several of these studies, I think that the market, with its forward-thinking usage, will be quite pleased with that kind of news, and that could prove to be a catalyst for the stock market.
Interesting, but it's encouraging what you mentioned about vaccine. But back to your risk factor, I'm just curious to have your thoughts regarding this probable Biden election. Back 6 months ago, if somebody mentioned to you, hey, the Democrats is coming, so I'm not sure that people will find that very, very positive. But it seems that things are not clear-cut, and they have a headwind and tailwind. So at the end of the day, Biden election, is it positive or not for the market? Just curious of your thoughts.
That's a very good question. We know that Biden is ahead right now in the poll. There will be maybe even what we call a blue sweep, a blue wave, where they could win both the Senate and the House. And some people are quick to point that, hey, you know what, Biden election will be, negative for the stock market, because he plans to increase corporate tax from 21 to 28, and that's in his plan. It's in the Biden plan. And also, they will increase what we call the GILTI tax, and it will also adjust the minimum tax rate. What is the GILTI, by the way? It's the Global Intangible Low Tax Income. It's it's a way that U.S. corporation can hide abroad across in other countries profit using the intellectual property. So you will make some adjustments to increase that. And overall, all those increases could total, depending on each company, but in average, it could total 9 to 9.5% increase in taxation, or an impact of 9 to 9.5% on profits, if you prefer. But you have to be aware, though, that will be compensated by other part of the Biden plan. First one, it will include, with the Democrats, you will probably end up with a bigger fiscal stimulus than the Republican. They're still talking about a $2 trillion COVID relief plan that would help individual and small businesses. There are also an infrastructure plans and an healthcare plan, and all of the other ones also that they could be added to that would total $5 trillion. So that will go a long way to help the economy. And also, the Biden administration has been have officially said that they would put in review the tariff, the trade tariff that were put in place by Trump regarding, for example, China. And there are good probabilities that those tariffs could be rolled back, and that would increase profit for U.S. companies by an estimated 5%. So those two things together could quite offset the increase in tax. So if the stock market reacts, very badly or badly, I think it could be it could be an opportunity to step in, because although some companies might be hit more than others, overall it should be an offset. So I think it's important to understand that. The other topic that I would like to talk about the election, and this one is a little more difficult to really know what's going to happen. It's what happened in the case of a contested election. Some people think that Trump might refuse the results at all, but I think that there will be tremendous efforts to sort out if they're states or it's quite tight. The civil society in the U.S. is really attached to democracy, so I think that it's not going to take long. At maximum, it's going to be a matter of 2-3 weeks before there's an official winner to the election. And from there, I strongly believe that whoever is the loser will have to comply. I don't think there will be so much trouble after that from Trump partisans. If it's the case, it might be during the election day, but I think that a lot of people will have a strong motivation to make sure that everything goes smoothly.
Very interesting. So I tend to agree. I think the worst case scenario, it's a contested election, but at the end of the day, now the gap is so wide between Biden and Trump. I don't know if it's a matter of hours or days, but it's not a matter of months before I recognize that he will lose. Okay, yeah. I'll let you continue.
Yeah, with but just to add a bit on that, the website 538 that follows very closely U.S. politics. Right now, as I read this morning, is putting odds of Biden winning more than 80%. So we'll see, but it seems that the results of the election hopefully won't be too contested. But another subject that is often, as I said, point out is valuation. And regarding valuation, when you look at the forward price earning for the Canadian stock market and the U.S. stock market, it's hard to argue that these earnings, these multiples are not at a high, even at a highest level where we haven't seen in a long time, especially for the U.S. around 20, a little below 21, let's say, multiple forward earnings of 2021. For Canada, we are at the top, although we are within the range, but at the top of that range of the last several years. So first glance, yes, valuation seems to be high, but there's two things I would like to add on that. First, we have to account now that the economy is much more digital than before. What does it mean? It means that we have to invest less for plant, machinery, equipment, and so on. So at the end of the day, the free cash flow available, the money that comes in the pocket or investor is higher, the proportion is higher than before overall for the stock market. So on a free cash flow basis, market is not as expensive as on the price to earning multiple. The second thing I would like to talk about is, and we're going to talk about it with this next slide, is the cost of equity. Why the cost of equity matters is when you look at forward profit. Let's say your profit for the year 2025. You have to put it in today's valuation. You have to use a discount rate that will discount that profit in 4 years from now as of today. And to do that, you need the cost of equity to do that discounting. So a huge part, an important part of that discount rate, the cost of equity, is coming from interest rate, long-term interest rate. You can use 10 years or 30 years. And what we can witness since the beginning of the pandemic is those long-term rates have come down significantly. So therefore, the cost of equity is also lower, significantly lower than it was previous to the pandemic. So what it means is those profits that are coming forward in the year ahead are worth more now than they used to because of that cost of equity being lower. And what is also interesting on that slide is you can see that according to the 3 different outcomes for the election, 2 out of those 3 means that the cost of equity will even get lower. And only a contested election could mean a cost of equity higher. And as I said, I don't see that as especially after a couple of weeks, as being the high probability scenario. So at the end of the day, that support higher multiple. And I think that's why we can live with higher multiple right now for the stock market on a price earning basis. So another thing that I would like to talk about this morning that support also the equity market is the changing of behavior and in the consumption patterns. And the best example for that is probably a Canadian company called BRP that produce Ski-Doos, Sea-Doos, and those 5x4 that we see on the slide.
And don't forget Spider, because I bought from this company, Spider, for my 65 years old.
So you're a good example, Clément. What I call this company is producing, I call it expensive luxury toys for adults. And a lot of people thought after the beginning of the pandemic, and you can see that on the chart of the stock price, somewhere in March, nobody will buy those things now that we're going in a recession. But because of government support, people have money, and also because some people that still keep their job or were used to travel, used to go to restaurants several times per month, now they have all that free money to spend on something else. And that is an example of things that they're buying. At the end of the second quarter, BRP, the dealers of BRP announced that their sales were up 40%, not compared to the previous quarter, the quarter of the pandemic, but compared to the second quarter of 2019, which means that compared to a normal year, sales were up 40%. That's quite significant, and that's why the price of BRP came back even higher than prior to the pandemic. So that's a pretty good example. But we see that kind of example elsewhere with car sales, for example, as we see on the next slide. Car sales are up year over year now. They're back to being, above 0% in terms of year-over-year growth, although they were down 40% in the midst of the pandemic. And you can add to that the inventories are pretty low right now of cars in America. They're 30% lower than usual. So that means increased schedule of production for auto parts for car producers. And there's a lot of examples, and it's important to know that the stock market is more exposed to good producing companies compared to service producing companies. Of course, there's still in the stock market companies that suffer from the pandemic. I think of airlines, for example, but there's a lot of companies that benefit from it, and there's more of them on the stock market. So that's another example of, something that favored the stock market right now. And the last example I will, talk about is also the housing market. Housing starts are rebounding strongly since the beginning of the pandemic, and that's another change in behavior of consumption. Actually, it's even more than behavior of consumption, it's behavior of life, because people are living downtown and they're going to the suburb, and they're even going to rural places because they think, and probably they're right, that they will be able to work from home much more often, if not all the time. So there's a lot of people that are interested to leave their apartment downtown and to buy a home, and we see that. And it's a change of behavior that's really important to follow.
So since very interesting what you describe as the behavior change, but just curious, since we have a privilege to have you as a lead portfolio manager on Canadian equities, to have your view closer to home, if you want, and talk about particularly natural resource. We know in commodities, we know how it's important for Canadian Stock Exchange. So what is your thought regarding that topic?
Well, increase of demand of manufacturing good is good for commodities, obviously, and furthermore, and we're going to see that with this slide where we take as an example 4 different commodities. There's even something more, helping the prices of those commodities is their supply disruption right now. And let's take, for example, copper upper right. There's supply disruption. There were supply disruption in Chile and Peru, and good demand for China right now. So we see the price, being above $3 per pound, and it's been a long time since we have seen that kind of prices. Same thing for iron ore production in Brazil. Brazil was hit hard by the COVID-19. Prices are up. We saw what happened. We just talked about housing starts, the lumber, and we know also that renovation activity, people were spending their summer at home, and they decided, well, if I have to live in my backyard, I'm going to improve my deck. So prices went to the roof. We never seen those kind of prices, and don't wait for me to tell you a date in that sentence, because we're never seen before that kind of prices. $1,000 per linear linear board feet is unknown before today. So prices have come down, obviously, toward the 600 level, but it's still much higher than usual. Same thing for corn. Corn is, since the beginning of August, as engineer an interesting rally. Same thing for wheat. Wheat right now, it has its highest level in 3 years. Soybean is at its highest level in the last 5 years. So commodities are really doing well in that kind of environment. And another one we can talk about is gold. Gold is important in Canada. As we know now, the sub-gold index is around 12% of the total index. So it's really important. And it's important also to know that gold is usually related to a lot of different things: interest rate, US dollars, but also inflation expectations. Always been a strong trigger for gold. If you see inflation expectation increasing, usually it supports very well the price of gold. And one way we can measure inflation expectation is with a very specific kind of bonds that the coupon is linked to inflation. It's called the break-even, the US 10-year break-even bond. And with the yellow dot here, you can see that the inflation expectation went higher with all the money being put by the different government program in the economy. And that inflation expectation kind of stagnated after the end of August and are down a little bit. It's because we're still waiting for that package in the US That's, I think, a good reason why inflation expectations are a little down. And you can see also that the gold subsector is down too, and it's down actually 14%, which is quite a lot. So some people might be a little nervous right now and maybe want to throw the towel. But I will give you an example that it's frequent to see those kinds of pullback for that subsector. If we look at the next slide, we're going to take an example, 2008, 2009 for the gold. And we see the blue line is the gold subsector once again that went from 1,000 to 3,000 level. So it basically tripled in 15 months. And during those 15 months, we saw 7 correction between 15 and 25%. So gold is notoriously volatile. So is also the gold subsector on the TSX. So it's quite normal to see those kinds of pullbacks. And with those, as I said, with that new fiscal package probably coming after the election, there's good reason to keep hope for the gold for the Canadian market.
Very interesting. So you encourage me to stay the course because I'm bullish on bullion with this interest rate close to zero for a while. And so this is what you can see on the chart, that it's normal, I will say, to have this significant correction even in the bull market. So shifting topic, and we will extend, I want to let the people know that we'll extend by 10 additional minutes to 11:40 to have the opportunity to answer a question. But before going to question, maybe in 2-3 minutes, just talk about your positioning. And I know you're very humble, so you will not, you refrain yourself to talk about performance, but I could talk about your performance since I am significant holder of your funds. So congratulations, Marc, first quartile on 1 year, 3 year, 5 year. So just curious of your positioning. And quick wrap up and go to the Q&A. We have a lot of questions. Go ahead.
Okay. So on this next slide, we'll see the different weighting among the 11 subsectors of the index, the weighting of the index and the portfolio, the iA Canadian Equity Growth, which is my flagship, 700 million plus in asset under management. So the people that knows me, from some time know that I'm not the kind of guy that will overweight or underweight a sector in a tremendous way. There won't be big spread between the portfolio weight and the sector weight. But there's some interesting one like healthcare, where I have some U.S. investment that complements some Canadian position. I'm overweight by 2.4%. Same for communication services. Some U.S. company triggered at overweight, consumer staples. And the notable underweight, there's energy. I'm underweight there. And also materials. I'm a little underweight gold compared to the index, but it's important to know that compared to the competition, I'm way overweight, because the competition is not always fully invested in the gold sector. Another thing I would like to point out quickly is the energy, that is now the 4th largest Canadian sector. And I make you a little prediction. I think that in 1 year or 2, information technology will be even more important than that technology. So yes, the Canadian market is still, geared toward commodities, but less as before. And it's probably gonna, go a little lower through time, I believe. And on that, we can, look at the conclusion very rapidly. I think that there's a couple of clouds right now over the market, the U.S. election, COVID-19 valuation, but these uncertainty will dissipate themselves in the upcoming weeks or at the most months. And I personally think it could go a little faster than last. And that could prove to be catalyst for the market. Let's remember that usually November and December are good months. That doesn't mean anything unless it's supported by fundamental. Fundamental could be a U.S. election that goes by without too much problem, positive results from the different one or several of the different vaccine study. And as I said, valuation is maybe not low, but it might not be as high as some people think. Major risk, we have to hope that a vaccine will be efficient as much as possible and will come as fast as possible. And we're not talking yet there only about results, but distribution, because the longer it drags, the more the economic recovery for 2021 that is expected could be lower, and that could prove to be a little challenging for earning expectation for 2021.
Okay, very interesting. So we have time, we go over time, and we have maybe 10 minutes for 3-4 questions quickly. So let's start with the information technology. You mentioned that that's about 10% of the market weighting, but correct me if I'm wrong, I think one single stock is half of this weighting. So Shopify, what is your view on that? Do you have this stock in your portfolio?
Yeah, I do have that stock in my portfolio. Depending on the mandate, some mandate I can invest in the U.S., so I tend to try to choose companies that are showing very good growth, like Shopify is showing, of course, but with less expensive metrics. But in Canada, I'm very slightly underweight Shopify, so the weighting is around, if I remember correctly, 5.7%. I'm closer to 5.2 right now, so a little underweight of 0.5. And why so? Because, as you know, probably Shopify is a clear winner of that pandemic situation, e-commerce. And you have to see, Shopify is probably the biggest competitor to Amazon because it supports all the small companies that try to compete with the Amazon website by their own. So it's not, it's pretty envious place to be right now. And it shows in the results, the growth of the revenue, even the control of their cost structure is improving. So they're showing very good results. But unfortunately, the price you pay for Shopify right now is fairly high, even on the less demanding metric of price to sales to EV enterprise value. It's still fairly high. It's above 25, and usually comfort zone is from 15 to 20. So there's a real tug of war between growth and valuation right now. I think that valuation for now on, growth has the upper end, but I will monitor very closely because that can change, fairly rapidly because of valuation so demanding. So that's why in portfolio where I can invest in the U.S., I try to find a better risk relationship elsewhere. But in Canada, I still think that, a small underweight is warranted at that point because it's such a good company. We learn more about growth, and at first sign of growth deteriorating, we will have to readjust our weighting.
Very interesting. Shifting topics now. Oil sands, energy. So oil sands, do you have still some future? And what is the impact of this new phenomena worldwide, ESG, the impact on oil sands as well?
Well, of course, ESG has an important impact on the energy sector. In theory, though, you should ask those companies under, ESG criteria to be better at producing what the good that they're producing, which is oil or natural gas. You ask those companies to decrease the level of pollution, the level of CO2 they emit when they produce. And a lot of companies are getting very, very serious at doing that, reducing their emissions, reducing their pollutions. And there's good success. So to me, in theory, that's what we ask to those guys, to those kind of companies. Some people will go a little farther and say, well, because of ESG, I won't touch energy at all. I think that energy is still needed, in our economy for some time. I think that, there will be tremendous effort to convert as much as possible toward cleaner energy. But as we're gonna go as fast as it is possible. And while we are doing it, we need, to produce fossil combustion. So, that's, I think, where ESG is important. I think to force company to behave the best, but it should in theory in there. So that's in that situation, I think there's still a good future for even for oil sand company as long as they improve the way they produce the goods.
Okay, interesting. So shifting topic. So what is historically it's Alex from Alexandre. Historically, data suggests that market perform well the first month of a year following an election. Do you still foresee the same thing will happen again in early next year?
Yeah, I think, well, there's possibilities. I would say there's possibilities that it happens that way because, as I said, I think that the Biden presidency won't be as bad for the market that it may fear at first. So that turns out to be a positive thing. But I think that at the end of the day, what will happen on vaccine development and FDA approval will be the most important thing that will support the market. I'm optimistic that among all the studies going on right now, there will be positive news. So I'm tempted to say, yeah, it should continue early next year. But beside those seasonal, behavior, I think we need something fundamental that would support it, especially right now that we're such in a special situation with the pandemic. I think looking back at what's happened usually might be a guide, but not more than a guide.
I totally share your view. It's very well said. Okay, I think time is running so fast. So it would be the last question. So any risk of a crash or something like that, or W, what is your view on that, and what would be the probability, or what could be the catalyst to see this kind of situation?
Okay, one of the reasons we have, as I said, returns being where they are since the beginning of the year and much higher than we thought, it's the government support. And I think that they've been really decided on that front to make sure that people and businesses will be supported. And as long as it stays that way, I don't see a high probability or even a low probability of a crash, to be honest. So, but that's where the vaccine also come into play. How long the government will be able to sustain that kind of efforts, because the costs are very important. Of course, as long as interest rate stays low, it doesn't cost that much to borrow right now, but at one point it might become a problem. So if a vaccine the faster a vaccine come and is efficient, the lower are the probabilities of such a scenario of a crash. If we are in 1 year from now and there's no real solution, no real vaccine being distributed, or no real treatment that is easy and accessible for everyone that doesn't cost too much, I'm gonna be a little more nervous, that's for sure. So, but I see the probability of that scenario being low for now. So I'm not that nervous about a crash.
Okay, it's a last question. I will let you 2 minutes if it's possible, but sorry about that because it's a very interesting question. It's from Jan. Hi, Marc. Could you please provide some general comments about real estate, for example, real estate income fund, and with this COVID? So what is your view on this real estate income fund, for example, that we have?
Yeah, real estate is certainly not a sector that is a clear winner this year, and it's I think we can understand why. But once again, you have to divide. When we talk about real estate, we cannot put all the companies that are in that sector in the same in the same pot, because there's the ones that are involved what we call industrial real estate, is even involved with the e-commerce, because we have warehouses where the e-commerce can be put before being distributed the last mile. So those REITs are doing well, and some could do even better. I think there's good opportunity of that front. I think that apartment REIT also will do better. They have not taken regained since the pandemic, since the low of March. They're still at the low. And although we see some movement from downtown to suburban, you have to be careful. Maybe you take apartments that are more exposed to suburban. But eventually, a lot of people are nervous about immigration in Canada. It will resume, you know. It's temporary, and I think it's then an opportunity to invest there. Retail, they're supported by the government. I'm a little more nervous, but I can tell you that the market is already pricing very negative assumptions for those REITs. So I don't think they will go a lot lower from right now. And offices, I think that at the end of the day, people will still need to gather, to meet. Maybe not 5 days per week, but at one point, I think that offices demand will readjust, but not way lower than what it is right now. So also I see, maybe it's not the time, but I see good opportunities in those REITs too. So somewhere down the road in 2021, REITs could turn out to be the best sector to invest in. You have to have a longer term view, and to be at this point, I would say a little more courageous, but that, you know, that's how you make money when you invest.
Very interesting, you know, and with central banks promise to keep interest rate close to zero for a while, I think that you're right, that real estate for people having a long-term time horizon, more 3 years than 3 weeks, I would say, or 3 months. I think it's a very good advice. So that's already the end. We can continue for another 30 minutes, but we want to respect our commitment. So very interesting for people who connect a little bit late. You can listen again. It's recorded. It is on the www.ia/economy that you can record and have access to the slide there. I want to thank you, Marc. It was a privilege and very, very informative. Thank you for your time.
Thank you for inviting me. Thanks a lot.
And see you, my guest next week at 11 o'clock next Wednesday will be Pierre Chapdelaine. Pierre Chapdelaine is portfolio manager for manage overseas equities. Have a good week. Thank you for listening.
Thank you.